I can hear you nice and well, Richard. Thank you.
How are you, Al?
Well, so far so good. It's a good week. So very excited to to hear from you and the participants today. So it was a good week for me. Thank you.
That's great. And look, it's a shame. Is Oleg here? I'm just running through his list. Hopefully, we get the intro from Oleg, but I can't see him on our list. I think he's no, I can't see him anywhere. But here we go. How are you, Oleg?
Hi to everyone. Maybe I have some traditional program issues in the beginning of our 24 in X spaces. Well, I'm very happy to be here. It's surprising, I think. So, hi Jerry, hi Richard, hi Alp, hi Absolute, hi Cardura, hi Marcel, Billy. All the guys I see here, my friends, all the new. I'm very happy to see you every time I'm here. So, it was very interesting week, and I was listening a lot about, thinking a lot about, of course, Transforming as every weekend, maybe for 10 years, every almost day I think about Transforming. So, and I was listening to podcasts with Jerry, Trendline's podcast, and I like words of Jerry that he said when he said that Richard Davis and Bill Eckhart told us if you follow the rules and lose money, you will be okay. And if you don't follow the rules and you end up making money, will be very upset. And I really like that, and I get remembered an old Russian saying that it's better to find something. It's better to lose something with smart friend than to find something with a dumb one. So, and also Jerry said that we must be focused on a right and hard thing. And in general, when we see something process, it's I mentioned many times that almost all good processes looks hard to most of the people in the modern society. I don't mean that it's hard to train yourself. And I think we must train ourselves. I always say this, nothing new. We must train ourselves to feel comfort and uncomfortable to many people, circumstances. And it's winning formula. And I even retweeted Mike Covell when he had a picture. I think you have seen this in my Twitter profile when so a lot of people going to uh, when people have the sense of this, that the people have a choice to go to something to win where they can win in a simple way, and a lot of people want to win. I have a thread of a little. So the sense with that a lot of people, all people want to be rich, all people want to win, and but almost no one wants to do the things that require us to be a winner. It's follow the rules, and it's a very important thing to understand. All of us to transform, to traders especially. That first of all we must be disciplined, must have clear mind, open mind, clear mind. Understand the logic behind our system, transformed or not. Because today I have seen a site with a lot of quant systems, and I was interested. I usually don't do this, but I have read a description of some systems, and I thought it's. I don't see any philosophy and any logic behind the systems. Even it was a description. It was written that it works for maybe 30 years or 50 years, but not transforming system. And I don't see any logic. For example, to trade only in the end of the month, such systems exist, or beginning of the month, and so on and so forth. But where is logic? Where is philosophy? Where is math here? Only narrative, only story. So I don't trust such things. Our transform approach is really the best I have seen, and at least I think it's a very, very great foundation, a great base, and it's very, very useful to every trader of all styles to understand our approach because we investigate how the markets are organized, how they work, on which principles it is based. And I think it's very useful to understand even for mid-reverting traders or short-term traders. I think it's very useful. It can help even them. So let's get started. I'm very happy to be here. And Friday is a very happy day for me because I'm going to trade in X spaces.
That's great, Oleg. Thank you very much. And listen, now that Jerry's away, this gives us a chance to all talk behind his back. So this is now when we bring up all of these things that we're scared to talk to Jerry about. I'm sure he's listening now and having a giggle. So, gentlemen and ladies, if there's any topics you'd like to bring up, do so. I've come back from Kuala Lumpur, so I've had my head out of the news, but I'm sure there are topics we'd like to talk about. You might want to talk about absolute momentum, cross-sectional momentum. I had today or yesterday, I had a great interview with the two Moritzes, Moritz Siebert and Moritz Haydn. We have this new podcast called The Algorithmic Advantage, where we're bringing in all of these bright minds and bright sparks to do these sort of long-form interviews and questions with them. It was a great podcast that's going to be released in the next couple of days. I hope everyone listens to it. They had some great opinions about all of the classic things we talk about, but in sort of quite highly developed ways with their research. They've certainly have done a lot of research in some of the areas we've talked about, like dynamic position sizing and all of these things. So if there's anything you want to bring up, we could discuss that. So it's free form while Jerry's away. We can get up to mischief. And so, Cordura, how are you today?
Hi, Richard. Hi, everybody. I'm fine. This trade, I just wanted to mention a couple of things that I read. Many of you should have noticed, for example, the interview with the guy from Renaissance in Goldman Sachs. That I think it's a great interview there. And also, there's a new book by Victor Agani, who was the guy who formed long-term capital management, among other guys, in the 90s. And I think I just bought it and I read through it, and I think it's a good book. He's a supporter of trend following now and other stuff, but he's very good at explaining things like position sizing, etc., from a non pure trend following view. So I wanted to just to say that, and then I don't know. I'm interested in talking about something that maybe it would be boring for these spaces, which is backtesting engines or structures and models, etc. But just wanted to say that. Thanks.
Do you think that it's interesting with trend following? When I started trading, of course, the furthest thing in my mind was trend following back in the 80s, and I was sort of doing value investing, fundamental investing, and trend following to me tends to be, I'm wondering whether it's something that over time, with experience, with the school of hard knocks, it's something that inevitably the traders that still survive inevitably fall upon as the solution to their nightmares of the past. And I'm wondering if anyone else has experienced that and would like to talk about it. It's certainly something that I find that as you get older, it tends to be more amenable to the way you view the markets. That might be a good discussion point we can talk about tonight.
Yeah, trend following is very safe. It maybe not looks very, very, very for people who don't understand our logic. who don't want to see our backtests, the evidence, the great evidence, our backtests. For example, Jerry's backtest, it's available, but people don't want to understand. A lot of people in the world, I mean, don't want to understand the simple conceptions. So it's very, very safe. Our trend following methodology is very safe, really very safe. And Jerry often says this, that when we analyze our drawdowns, it's drawdowns in a long-term trend following, the safest way of trend following long-term approach, I think. And we analyze this, we see that it's a drawdown from peak to valley. It's drawdowns from the high. So it's some kind of price we pay for our success, I think. And the very big problem in our space that most people in the world don't understand this. I think a big problem for our own business side. I mean, to attract investors' capitals. But it's very, very safe decision, very, very safe methodology to be a trend follower. And it's plenty of evidence of that. All crises, trend following methodology survived all the crises that we have seen.
Yeah, no, good point. So to me, trend following, everyone complains about the volatility of trend following, but inevitably I find that these markets do not offer persistent edges. So to expect an edge to be consistently derived across time in a sort of a linear, continuous sort of building process, I think is that's more to me a magic trick where people are playing with risk, adjusting risk across their portfolio, smoothing things out. They're not necessarily extracting an edge. It's an approach of sort of obfuscating the risk of that volatility within their portfolio to develop these smooth returns. Does anyone have any strong opinions about this? Because any particular trading model you apply in the market, there are times when it works and there are times when it doesn't work. And, to understand when your model is curve fit is to understand that those times that the specific designs of your model have been sort of developed to target a particular edge. If that edge is not present in the data, but you are performing, that is a clear sign of having an overfit model. And so, I'm just wondering whether people are playing with noise, people are playing with all of these aspects to smooth their returns, and they find that if they sort of dig deeper into the performance results of their strategies, which are smooth strategies, they'll find that there is this inherent volatility, and what they've been doing is effectively smoothing that by transferring risk about the portfolio or holding on to risk, warehousing risk, all of these things. So does anyone want to talk about that?
A little comment. I think that, first of all, we must not sacrifice our performance and not sacrifice even not, first of all, our robustness. So with smooth returns ideas, a lot of them, they sacrifice robustness. And another problem is warehousing risk. So we will understand that the risk was there. After, we will lose a lot of money. So I think that the best decision smoother the returns is massive diversification across frames, across nothing new. Now I'm talking nothing new. Across time frames and across systems, across markets. And it's really free lunch in finance. Because I liked when Moritz said that he was speaking with a lot of guys who do vol targeting, vol management, and he said that they even don't know why they are doing this. They don't know this true mechanism, this what's this logic behind that, and so they just do it, and it's not the best approach. I think we must understand what we do. So my point, and I know that most of your points, is that we must massive diversification, and across all we can, diversificate all fields we can.
Bruno, how are you?
I was trying to hide in the crowd, but
no hiding here, Bruno.
Summoned. Okay, I'm picking up my thoughts here, and I think the discussion you're proposing is to think about where this return of trend following or whatever strategies, where does it come from, and in the most fundamental way, I think it comes from transferring risk from one counterparty to another. That's where we get returns from the markets. Trend following is basically a risk. I see it as a risk factor that we are willing to bear, and then we expect to get some return from it. Now, if you try to attenuate the risk you're getting, well, then you're giving up some of the return you're supposed to get, I think. I don't know. I'm a bit confused here because I'm trying to connect these things. I got reminded of that catchphrase from Corey Hofstein that risk cannot be can only be transferred, not.
That's right. Yeah. Yep.
So if you may be transferring to somebody else, then you're giving up return, or otherwise you're just hiding it and warehousing it, as you mentioned. I don't think we can get rid of it altogether. We can attenuate perhaps a little. Perhaps we can find better models that benefit from a risk factor in a more robust or more efficient way than another. But I think it's a fool's errand trying to completely attenuate risk or completely smooth your return profile.
Yeah, it's interesting because many years ago I did lots of work comparing and contrasting, say, mean reverting models and trend following models. Now, we know that there are these different edges that exist in the market. And when I was looking at mean reverting models, I noted that when I undertook the back tests on those models, when you took them out of sample into unseen data, the expectation is that mean reversion continues immediately. So you're hoping that the trajectories of those back tests extend in a similar manner in your out of sample phase. And if you find that it falls off the cliff as soon as you turn your models on, you drop your models. Now that's totally different to trend following models, because when I started doing my research on trend following models, I found that you could immediately accept the fact that there could be long periods of time, 6 months or whatever, of underperformance, but you can't afford to drop your models based on underperformance and you're out of sample, provided you're confident that your models can capture that edge when trends arise in that market. And when I'm comparing and contrasting, say, pattern recognition approaches, mean reverting approaches, etc., the expectation is that there is immediate performance as soon as you take those strategies that you've honed and developed into the live environment. But it's totally different to trend following, where you've got to passively sit with these models in the land of uncertainty, recognizing that if there are no trends about, you've just got to be patient. And to me, one of the hardest things I found mind was trying to change my psyche to accept that don't expect immediate performance with your trend following models. And so, when I started getting into trend following in earnest, it would be, when I developed up programs, it could be, a year or two before the models all start getting traction and start working how you want them to work. But in that initial, 2 years even, you get this incredible volatility. And, the scale of the volatility that we're looking at, we're so concerned about the volatility when we're getting these progressive sort of slowly building drawdowns. Everything's going up and down, up and down. But as soon as you catch those outliers, they are such non-linear, impactful events on your portfolio. Suddenly you think to yourself, what was I worried about? Why did I concern myself with this volatility? When these outliers, which I specifically hone my models to catch, suddenly deliver all of this bounty and make that volatility sort of like nothing to worry about. And yet I was so worried about it when I didn't have those outliers in play.
Yeah, I don't have that much of an experience with these mean reverting models. The couple I tried to test and program didn't get much far from the from the spreadsheet because the results were nothing spectacular far from that. But what I try to think, I always try to think in these terms that what is the reason behind a specific strategy? Why should that work? Who is on the other side of the trade? And I get a sense that many of these mean reverting models don't have that much of a don't spend many thoughts on that. It's basically trying to find a pattern, and that's it. I have some. I find it difficult to believe in a strategy like that because it might be simply a statistical fluke. They're confounding with anything deeper. And in trend following, I can see the who is on the other side of the trade. I can see that people are usually they don't they don't want to wait for the trend to develop fully. They get out of their trades too soon, and that's what trend following benefits from. The trend followers benefit from. I mean, I can see a reason behind a carry trade. I can see reason behind value trade. I can understand that, but when we get to those, I will simply apply an artificial intelligence model here to try to find the best trades, to find the best patterns. Then I don't know. Perhaps I'm too dumb, but I get lost there.
Yeah. Yep. Alp, you've done some good tweets this week on complex adaptive systems. Obviously, you're getting your head thoroughly burrowed into that idea. Anything you'd like to share?
Well, Richard, now, I come to a conclusion that, I mean, what are the pillars of good trading? So there is definitely an element of psychology. So, a new trader who would like to take this journey needs to invest his psychological makeup. So these cognitive behavioral biases is one thing, mental states, NLP, Jungian psychology. So there is that going on at one end. Now, in today's world, it is almost not possible to do this thing with technology. So you have to have a good grasp of technology, okay? And if you might want to work with a technologist, hire someone else and develop code, or you develop your own code. So there are two alternatives there, but you have to be very technologically affluent and familiar with what is happening. So that's a second pillar. The third one is, of course, you have to know how the trading works. So you have to have a good trading background, a trading concept, which is trend following. In this case, we don't even question that it is out there, so that's there. And I have noticed among all those things, we need to know this system dynamics. System dynamics, which I started looking into it with the book that you have suggested, this chaos theory. Then when I started to research more about chaos theory, I ended up with the system dynamics and the catastrophe theory. So that's like, how do I say? That's like the secret art of what is happening within these trading systems, because I'm not trading like a discretionary trader, am I? So what I do is I'm a system designer, and this system at a scientific level has some properties. So it's fascinating, this chaos theory, catastrophe theory, and what are the pillars of systems and how do they behave under certain conditions is very interesting. And I don't think that the work that we are doing is nowhere near complete with some understanding of those four pillars. Okay, so a lot of people talks about psychology. Everyone has an understanding and appreciation of technology. The trading. Everyone talks about trend following versus mean reversion, but the system dynamics, was never been a big subject. And I picked a lot from you, Richard. So I'm grateful for educating me on that over the years, last year and this year. It has been great, actually. Now, the things that we are talking about is, these external factors. And when these external factors hit the trading system, these trading systems actually goes from what we call phase transitions. These systems are either in a higher high, a state, or in drawdown. So there is no other state. So either trend following systems is going through a higher high, which is quite rare compared to the drawdowns, because you spend a lot of time on the drawdowns. Or another state could be you're either in a winning streak or in a losing streak. If you're or another state could be phase transition between model states. Could be, if you're using this cutback rule, which Jerry Parker talks a lot, where either using a cutback rule because you're going to a big drawdown, or you don't use it. So that is there. Now, what happens is, while we're going through these phase transitions, the trading system goes from one stable state to another stable state. And when these external factors hit the trading system, if your trading system is a good one, then you know that the fluctuations of the parameters within the trading system is going to be within acceptable parameters. And that trading system is going to, when last year, these bond trades were giving outliers. And when you have those outliers, you were making money. But this year, between January and May, you didn't have those bond outliers, and you made a lot of loss. So what has happened is, these trend following systems were making a lot of money last year in 2022, and until the start of the equity bull market at the end of the May, then you need to go through a certain drawdown. And these systems goes through from highest high to drawdown. So there is and the systems are looking for this local stability all the time. And if you have designed your system good enough, then the parameters of your system is going to be fluctuating under normal circumstances. And these properties that we are talking is very different than designing another trading system, because if you're not actually looking into a trend following system, but another system, then you may want to actually measure certain statistical properties, like the maximum number of losing streaks or winning streaks, or you might want to have an exact number for your expected returns, or your drawdowns, or your MAR ratio, or your Sharpe ratio, or your Sortino ratio, or whatnot. So we don't actually specifically look into the world from a statistical properties of the trading system. Okay, so that's very important. But we're looking to whether the stability of trend following systems is connected to the normal fluctuations or not. So that's a big difference, I guess, and that's why I choose not to apply the Kelly criterion, because it requires certain assumed statistical parameters, and with the systems that I am running, a trend following system, a classic trend following system, may or may not be bounding by those properties. Now, when we look into the chaos theory, Richard. So, because you talk about a lot about this chaos theory, now chaos theory, chaos theory for me, and catastrophe theory. Okay, the chaos theory is mainly talking about what happens if there are small changes on the initial conditions of certain parts of the system. So that's for me. That mainly describes the chaos theory. Small changes on the initial conditions of certain parts of the system. And a lot of people in the trading world will say that exit parameters are more important than entry parameters. And in the context of if you're looking into your trading system from a with the chaos theory point of view, you would understand immediately that your entry is as important as your exit, because these small changes on the initial conditions could be any part of your system. It could be your position sizing, it could be your stock selection, it could be your entry or exit or whatnot. It could be really anything else. So I think that is an important parameter, and we have the catastrophe theory. And catastrophe theory is not only catastrophe theory mainly refers to the black swans. These um, microsecond changes, these sudden changes, these black swans, and catastrophe theory looks into these sudden changes on the trading system, where you end up making a lot of money because suddenly there is a big event happening and you just catch that. Recently I was trading Tupperware with a short-term system, and the Tupperware gone from $1 to $2 to $3 to $4 to $5 to $6 in a matter of 2 weeks, for instance. So when this thing happening, you're catching the catastrophe theory on the positive side, okay? But it could so these black swans could be positive black swans, or it could be negative black swans. But these trading systems has a working theory, a property of engaging with the catastrophe theory. So these are this is where I am at the moment, and I continue to read and write, and I will say more to come. But I'm finding it fascinating. All right, and to anyone else who's listening to this, I would highly recommend to get familiar with system dynamics. You don't have to know every nitty-gritty stuff, but it's I would say it is foundational. Anyone else who would like to take the journey of a trader. Thank you.
Yes,
How
Alp.
would you recommend to start with that? How would you
Have a read of
recommend?
that. Have a read of Tim Palmer's book, The Primacy of Doubt. It's a wonderful book because Tim Palmer is a mathematician and physicist who is well renowned in predicting, weather events. Very, very, hurricanes, cyclones, predicting trajectories of these non-linear events in weather systems. It's a fascinating book, and he sort of draws analogies with the financial markets, and he wants to sort of take his skill set into the financial markets, and he's very much talking about the same principles that Jean-Philippe Bouchard has been sort of stating in his research, and in relation to his microstructural research of price. And look, the reason why I've become very attached to looking at trend following in these terms is that I think with trend following, with the nature or the properties of the edge that we're seeking in these markets, it is strongly associated with tail properties of the distribution. And these tails in the distribution are inherently fairly chaotic in nature. And there are so many analogies that can be drawn with weather systems, particularly when you look at these models of the markets as being sort of collections of agents in those markets. So the impacts of the single agent and the impacts of collective agents in that market, and how the structure of the market from those interactions, there's two forces going on. There's one of the gross structure of those relationships between the collectives and the agent participation, and then there's the individual actions of the participant and the sort of the dynamics, the interplay between those reactions leads to these endogenous trends existing in any individual market. So most people, when they come to trading, they're thinking in terms of, information releases into the market being the primary things that move price. They're looking at the releases, the FOMCs, all of these things, and they're assuming that these are the things that drive price. And fundamental investors have this presumption as well. But what Tim Palmer strongly suggests, and so does Jean-Philippe Bouchard, is that there are these endogenous reasons within the market itself, the nature of the agent-based interactions, which are accounting for about 90% of these major endogenous price moves. When they look at the impact of news events on moving price, coming from external sources to what we call forcing into the system, this only represents about 10% of how they relate the. So what they've done with their microstructural research studies is they've actually looked at each major news event and then looked at its impact on the price of the markets it's affecting. And from that research, this is where Jean-Philippe Bouchard recognises that 90% comes from endogenous factors. Now, not many people focus on these endogenous factors, but one of the key principles of absolute momentum is you'll find the reasons for why we like absolute momentum embedded in this principle of the endogenous features within the market itself, which leads to these chaotic properties over the long term. And when we talk about chaotic properties, we're not necessarily talking about anarchy in the markets. Chaotic models actually have long periods of semi-predictable states, then interdispersed with these transitions that then move it to a different state. So it's about, over the long term, how the states never return to the original state. So there is no repetitive pattern in the markets over the long term. It's this sequential sort of entropic direction that the markets take from state to state, interdispersed with these transitions. That's what leads to this chaotic nature in the markets. And trend followers, of course, are extracting their edge from these major anomalies or these outliers, which are represented by these transitions between these sort of semi sort of equilibrium states that exist during fairly predictable phases, and then they're punctuated by these transitions. The tails occur, then we move to a new state, and when we're sort of trading over 30, 40 years, we have multiple transitions occurring over that time frame, which account for the edge that we're extracting from the market. So it's a totally different edge to, say, those who are seeking patterns in the market, those who are seeking mean reversion in the market. They are symptoms associated with the predictable nature of the market, but the edge we're extracting is associated with the chaotic nature of the market. So it's a fascinating read. Tim Palmer, get into that, and it just gives a different way to understand trends.
Richard, can I ask you a follow-up question on this while we're talking? Now, I was thinking about this ensembles, okay, which you're doing the work with the ensembles. I'm not doing the work with the ensemble, so you will be familiar with it. Now, my understanding of it is a single breakout system is going to be, you know, chaotic in nature anyhow. So it's going to be capturing these non-linear relationships anyhow. So a breakout system, a moving average system, a band-based model, a regression-based model. So these are all going to be non-linear on its own. But a moment ago, when I was giving an example from a catastrophe theory, a black swan could be a positive or negative. But when it comes to using ensembles, the main purpose of using ensembles and changing your initial conditions in the context of chaos theory with many different entry models, the main benefit is going to come from when you're engaging with drawdowns and volatility, as opposed to your absolute returns. So a single model may the returns obtained by a single model versus 100 models, when you compare those two, their return profile will not be too different, but there will be a huge difference when it comes to the volatility and the drawdowns. Am I making any sense there?
Yes, Al, I'm hearing you. So, look, the reason I like ensembles is that it's giving me maximum loose pants. And I'll just explain it like this. So, when we apply a single trend following system to a fairly chaotic regime, we're applying, this loose pants principle to allow price to have many different possible forms of trajectory that are not adverse to our risk. So we're giving freedom to move for price, recognizing that in these fairly chaotic regimes, we can't apply precise models. We've got to allow price to unfold in its very volatile and highly unpredictable state towards future profits, but we always minimize our adverse risk. So when I'm using an ensemble, I'm using 10 different types of trend following systems that's giving me ultimate loose pants, because even a single system in these chaotic environments is going to be whipsawed about within those chaotic environments. And this is likened to Tim Palmer's approach of using ensemble forecasting methods for predicting hurricane trajectories. And the way they do that is that they don't use single models. They use maybe 10, 20 different different forecasting models. So we think in terms of 10 or 15 or trend following models, to basically have the greatest chance of being able to extract information from that very chaotic structure. That's the way I'm thinking in terms of using ensembles. So when I use an ensemble of trend following models, say on orange juice, I chucked up a chart the other day on orange juice where I've got 10 trend following models. You'll notice that every single model, there are times where it gets snagged. A single model gets snagged out and it might take a long time to get back in. But when you're trading an ensemble of 10 uniquely defined trend following models over the very long term data set, I tend to feel as though I extract the most possible alpha from those outliers by being as least precise as I possibly can with my approach to extracting an edge from those chaotic markets.
Thanks, Richard.
Moritz, how are you?
Good, doing good. Thank you, Richard. Just joined you guys 5 minutes ago, so listening in.
Don't listen, participate, please. I need help.
Yeah, happy to. You guys were talking about ensembles. I think we touched on that before. I'm a fan of using a couple of models, not too many. I don't think you have to use 10 or 15, but 2, 3, 4, something like that is probably good enough. It's like, meteorologists. They use models, probably not just one, and they have strong predictive power on average. But any single one of their forecasts, like is it going to rain exactly this afternoon at 3 p.m., is going to be very volatile. So you can smooth out some of that imprecision, like you say, to allow you to keep these loose pans and have a bit more diversification by combining 3, 4, maybe 5 different model types and speeds.
Richard, you mentioned about the endogenous moves within markets, so got me thinking. Um, so say you're in an equilibrium state with a set of prices. Then something happens and you change to a new equilibrium. I can see the role of trends here because things don't change all of a sudden. People don't get convinced you're in the new equilibrium all at once. Information flows in an imperfect way. Information is absorbed in an imperfect way, and that's why trend happens. It takes some time from you to get from one equilibrium to the other. Now, you're saying that the endogenous moves is these imperfections that delay the movement of price from point A to point B? Or are you saying that the endogenous moves is what causes the reset of equilibrium, the dislocation from point A to point B? And if that's the case, if I got it correctly, you're saying that it doesn't need to have new information or not, and anything new to happen from you to get to point A to point B. It's as if it randomly changes. Things randomly go to one equilibrium to the other. Okay, what am I missing here?
No, that's right. So if we imagine the properties that exist within the market itself, it consists of agents, and those agents are traders and investors. Now, when we're looking realistically at markets over, say, a 2-year, 3-year time frame, a lot of those agents come in and out of the market. Some of them leave the market. There is this continual shuffling of the mix of participants and their behaviours in the market. At a single market and the participants and the reasons that they're trading within that market, irrespective of information coming into that market, there are enough reasons for these non-linear mechanics to cause chaotic behaviour. And this is exactly the situation that Edward Lorenz found when he was studying weather patterns comprising collections of gas molecules. He found that when he came down to the simplest form of explanation of the mechanics of weather, such as clouds, he came down to these three broad form nonlinear equations. Now, it's interesting that there were three nonlinear equations in his simplistic analysis, because when you get three separate nonlinear equations, they themselves are sufficient to create chaotic behavior in the markets, because there is no single equation that can be used to define the long-term properties of that market. You need three separate equations to do so. And in physics terms, when you can't describe a system with a single equation, you know that that system has fractal structure in it, or nonlinear mechanics driving it, which means that it is inherently indeterministic over the long term. Now, this is, I think, what we're finding in the financial markets when we're looking at agent-based models and the way agents and collections of agents work in the market. There's these non-linear relationships existing between a single agent's behaviour, collections of agents' behaviours, what your neighbours are doing, what others are doing, to create this indeterminacy in a single market. And what happens with this particular form of model, this non-linear model, is you find that the model itself doesn't occupy all the possible spatial states that Gaussian statistics implies. For instance, Gaussian statistics assumes these assumptions such as homogeneous properties within a market. And what that means is that they're very simplified models full of, the efficient markets, the rational investor. All of these things are ways to basically develop homogeneous assumptions within the market to sort of eliminate the impacts of the fine detail to make their models work. And it's this exact elimination of the fine details, particularly when you're dealing with fractal structures, where the small fractal structures are important, as are the large fractal structures. When you start removing in your assumptions that the fine detail, where those fine detail assumptions matter, such as in nonlinear mechanics, we find that the models become hopelessly simplified and not sufficient to express the behaviours that we exploit, such as the tail behaviours of the market that can't be understood by the Gaussian model. They have no, the efficient market hypothesis doesn't really have a good explanation for why tails occur, and they're always caught out in financial crashes. Why did that 5 sigma event occur? They've got no reason for it because they don't, their assumption is it's all based on information coming into the market, and yet the behaviour of the market says, well, in this case, this market rout was not necessarily caused by information. This was caused by market behaviour, behavioural psychology, all of these things, the way the agents participate in that market. And you, EMH, have totally over-exaggerated the importance of news events, fundamental factors, etc., in describing your models. In real-world situations, we've got to recognise that most of the market mechanics is associated with the behaviour of the participants, because the participants themselves, in their behaviour, are sort of putting a force in the market through their buy and sell decisions. That's implying a motive force into the markets. And when you look at collections of agents all doing the same thing, they are applying a greater applied force than smaller numbers of participants doing a different thing. And that's shifting the mix all the time, which is causing this chaotic features of the market that we find that even if there is no news coming into the market, we will get these chaotic properties.
I like this very much because really the driving factor is endogenous events, and it's very good studying, very good learning, scientific approach, and I think that it's a very big mistake of the people to associate the market with this mainstream media big events that we all know. But in fact, we don't know all the picture of the mainstream media big event. We don't know the picture. And we can't know all the decisions that can be made by a very big maybe players in the market, very big banks and something like that, big companies, because they know more than us. It's only my thoughts. And I think, of course, this endogenous events, it's a very, very big factor. And the real decisions also of a participant, especially maybe big participants of the market. And so all this uncertainty, all these factors that Richard was talking about, they forms big moves, big outliers. And our task is to have a good universal algorithm and follow our rules. And so it makes this in this complex world, in this complex situation, we have simple decision, simple technique. And I like when maybe 2 years ago Richard said that we do these simple techniques not because we are so dumb, but because it works, because we have a deep philosophy behind this and we understand how it works. And said the same similar thoughts that I have now, that it's very important to understand how your system operates. So I like the theory very much with endogenous event theory. I like this very much, really.
Thanks, colleague. Mangesh, you're new to here. Welcome.
Yes, so I have one question. Can I go ahead?
Yeah, go ahead.
So since all are trend followers here and believe in trend following systems, so my question is, what is best approach to minimize drawdowns in trend following systems? Like, is it a diversification or trading lower time frame, something like that?
Yeah, look, so I'll get Moritz to sort of talk after this, but I think extensive diversification in terms of markets is a great one to reduce drawdown. So what we're trying to do is the fewer markets you participate in, the less chance you have of capturing outliers, and worse still, the greater those outliers are probably going to cluster together. The greater degree of diversification we have across markets, that we tend to find a greater frequency of outlier representation with greater diversification. And more importantly, those outliers are less clustered. So ideally, when you find that your outliers are clustered together, obviously you perform very well during those periods if you are positioned the correct way for those outliers. But during the periods that outliers are absent, you underperform. And when they're clustered together, you get a very volatile equity curve. Drawdowns occurring before the clusters occur, and then you get this massive step up in your performance when those clusters occur. So with diversification, you're trying to spread those outliers up across the time series in your portfolio. So that's the market diversification. And I find system diversification does a very similar thing. It's spreading the impact of outliers, because outliers is not just a consequence of the markets we are trading that possess material outliers in the price signature. It's also the outliers that are represented by how our systems interact with that market. So our systems have design constraints. Some of those systems just happen to get in at just the right time and then last for very long periods of time. So our systems themselves, the designs in those systems, lead to outlier opportunities, how they interact with that price. So the combination of market diversification and system diversification tends to smooth out your performance and make it less lumpy, I've found in my models. And also with the greater diversification, it's forcing you to apply smaller bets to each position. So you're less concentrated in each position you get to, which means that by being less concentrated, the impact of outliers are still felt in your portfolio trade distribution, but the losses, of course, because you're trading much smaller positions, are also much smaller. And so what I find, the small bet size with massive diversification also assists in reducing the level of volatility in my profile, my portfolio. But Moritz, have you got any thoughts on this?
Yes, I'll do the Charlie Munger and just say I agree with everything you said, Warren Buffett, like they always do in their general meeting. But I apologize in advance for my cheek and tongue answer. I think the best way, well, I think I'm convinced the best way to avoid drawdowns is to not trade. Now, this doesn't help you, obviously, when I say that. The second best way is to trade very small. But then, I would bring that back to think about what it is that you'd like to achieve when you trade, when you run these systems in the markets. Are you looking to reduce and avoid drawdowns? Well, I don't personally think that is a good objective for trading, because I believe that the reason we're in the markets, and at least the reason I trade these markets, is because I do want to make money. I want to make a good return. And I realize that drawdowns and losses are a natural byproduct of that trading process. So, answer the question, to what extent can you stomach these losses and these drawdowns, which will, by definition, occur? If you want to make money, you have to take risks, clever risks. If you avoid all risks, you're not going to make money, or you get the T-bill rate of return. So it is this balance between your psychology, your level of your willingness and your capability of accepting losses and drawdowns without freaking out, and balancing that against what I think is the objective of making money. If you want to make double-digit returns per year, this is very unlikely going to happen with less than 10% drawdowns. You can have less than 10% drawdowns for a while, but at some point, it'll materialize, and you have to be prepared for that. So I agree with everything that Richard has said. Diversification across markets and timeframes and systems, and all of that helps. And to the extent that you can do it, because your trading level or your account size allows for that, then I suggest you do it, because it is a diversification benefit, a risk benefit that you can harvest with your computer.
you have two. You can analyze the thing from two fronts. One of them is how much you're losing on the trades once you close them, and that you don't have much to do with. Has a lot to do with what the markets are giving you. So perhaps you can have better systems um, uh, um, that can exploit the trends in a better way. But if the trends are not there, you don't have much to do. On the
Bruno,
other
just I
hand,
want to add one thing, so you can answer the continue ahead better. So
okay,
I agree with you, I agree three of you completely, but just thing is, out of the trend following systems, I can't make a business when I'm handling money. That's my mindset. If I'm handling some clients money, 10% 15% trend following system drawdown, I can handle that because I am a trader, but my clients can't handle that, right? So how to make business out of it? So in order to make a business out of a trend following system, we need to have better sharp ratios. That's what I feel. So can you explain that part also, like how to make some good sharp ratios? If you can answer that, it will be a good for me.
in that case, I'd have to go with Moritz number one solution. That's don't trade trend following.
I'll take that. We would love to have sharp ratios of greater than one using our trend following trading systems. I think that trend following systems that have a sharp ratio greater than one are probably very fragile and very, very non robust, not resilient. Probably the result, or very surely the result, I'd say, of curve fitting. We're living, I think these systems, I love them. They're great, but they come with volatility and choppiness and maybe a sharp ratio of between zero point 0.4, zero point 0.5, zero point 0.6, zero point 0.7, somewhere in that range, depending on the markets that people trade and how they trade it. But it's going to be less than one, I think, these resilient systems at least. So and a lot of people on this space here, we've put hours and days and weeks and months of research, thorough research into improving our systems. Maybe improving the risk-adjusted returns. We failed. I have failed. And I think Jared and Richard would agree with me that we're not getting to that destination, or at least we haven't got to the destination of greater than one sharps with trend following trading systems. It is something that I came to accept. It is also then when you step back from it and you think about a 0.5 sharp, if sharp is your measure, that's actually pretty good. If you can avoid blowups, then that means if you trade at 20 vol, you'll make on average 10% per year. If you compound at 10% per year for years and years and years, or decades even, depending on your age, that is actually a cool thing. It's not bad. So I don't know. I think you're probably better off being realistic about what it is that you can achieve with these systems in terms of sharp, right? In terms of making a lot of money, you can make a lot of money with 0.5 sharp. But yeah, it is what it is. I think you'll run a great risk of overfitting your systems and eventually harming yourself if you push too hard and force yourself to create a backtest that has a greater than one sharp with the stuff that we do.
I agree, Moritz. And the way I think is that if you have a high sharp, greater than one sharp over a 30-year period, I haven't seen it. I haven't seen a 1.5 sharp over 30 years, 40 years. What I do see is I see two sharps over 5 years or 6 years, and then I see a blow up. And the way I see these markets is that if you want high sharp, go for the risk-free rate. And what you're going to do is you're going to significantly reduce any lifting power, but you're going to get the smoothest possible return possible, but you're going to miss out on the entire wealth. You're not risking anything. And this is where Moritz comes in. You do have to take a risk in these markets. You've got to embrace the volatility, because that's actually a sign of a healthy strategy as opposed to one that's concealing risk. So when it comes to dealing with the clients, all of us can apply tricks of the trade to reduce and make our process smoother. But and we could do it for 5 years, for 10 years. I can do martingale models for 5, 10 years. But I know inherently in those models lies this incredible negative skew event, which is going to hit me one day in the future. And I know that I'm not doing my clients a service by offering them that smoothness, because there's warehoused risk in that smoothness that I don't know when that's going to pop up. But I do know that I can, do this window dressing trick for a long period of time, keep the clients happy, maybe bring in AUM for a long period of time. But ultimately, I know that I'm an LTCM in action when I do that sort of thing.
I agree with all guidance, really, and I think there's a big mistake for a lot of managers to avoid. They want to avoid the rounds to the smoother, and they make their systems too complex. A lot of filtering, so on and so forth. I accept filtering, especially in a short-term space, of course. But as Jerry often says to us, we must not. One of the main things is not to miss a trade, because we can miss an outlier. And so, really, for a long time, for example, we may have a filter that will avoid a lot of drawdowns for 5 years, for example. But later, we will miss trend, and after that trend that we had missed, that outlier move, we will have a big drawdown, and that filter will not help us. So we must be very, very cautious in filtering. It must be simple decisions. It must be simple decisions, and in any case, we must not miss a trade. It's really a big issue, and I think a lot of managers do these wrong things because they want to attract a lot of investors' capital. And we must have our core principles, according to our philosophy. And so this idea of smoothing, the best decision is, I agree with guys, that to have more markets and more systems, more time frames. And maybe if you want to have a better shot, maybe to be more short term. If you're short term, yes, you don't have these big drawdowns from peak to valley, drawdowns from the high, in fact, and it looks better. But I have said my thoughts before that, and but I want to say that really I agree with the guys, and I want you to be cautious with the filtering and making your system too fragile, because it's very important thing not to make your system fragile. Uh, Especially sooner or later, it will be very, very big moves because of unexpected events. And so this warehouse and risk situation will see this. And I think it's better to think about this now.
Absolute. How are you?
Okay.
Sorry, you go, Bruno.
Yeah, really quick here. If you go short term, you reduce the potential of open trade drawdown, but you do not reduce the potential of closed trade drawdown, because you get whipsawed a lot. So there is a trade-off there, no doubt. But with the shorter term systems, you get the impression of reduced drawdown. But if you get in an environment without trends, you're guaranteed to have a significantly larger drawdown than the longer term systems.
Hey guys, hi everybody. Um, yeah, it's weird without Jerry. What is he doing? Is he just listening, or is he busy with something?
He's
Uh,
testing us out. He's testing us out. He's listening, and he's probably having a
yeah.
laugh, and he's probably saying, "Come on, jump on that one. Why didn't you say that?"
Yeah, it feels weird not to have Jerry to argue with. So, so yeah, I don't have much to say. I mean, I usually don't have anything prepared going into these things, and I'd like to just sort of comment on some things that people say. Just I'm just the typical reply guy. I come unprepared. Um, so I one comment on when Richard was talking about the ensemble approach, and I think we also I believe I made this comment before, maybe a few months ago in one of our spaces. Uh, the the gradual approach of offered by the ensemble approach, and so diversifying across markets and then diversifying across timeframes and across models. In as if you see it from a universal standpoint, when you aggregate all that, you end up having a system which pretty much constantly adjusts position sizes in almost
Continuous
all.
system. I know you're getting to
Yeah.
that one.
And I think the next level, and I have done some studies and analysis on this, and I mean, for the 20 plus years I've been trading systematically, I have always found that continuous systems are far superior than any binary systems. And to the extent that you can make things continuous, I almost feel like you kind of sprinkle a statistical chaotic dust onto your system, which prevents you from being too dependent on specific and exact timing of the binary systems. And to the extent that you have some statistical edge, sprinkling this chaotic statistical dust around entry points and exit points and adjustments inevitably improves risk-adjusted returns, be it as you measure it by Sharpe ratio or return to drawdown ratios. So if and I'm not necessarily sure that you can do this with every possible system or trend following or classical trend following with one entry, like with specific entries and exits and whatever. But then there's a whole universe of other approaches and systems you can design that are profiting from the same, as you said. And I, by the way, I agree with Richard that most of the fatness of tails in price returns come from endogenous events rather than from exogenous events. It's mostly driven by the complexity of interaction of all the agents, which are human agents with repeatable psychological characteristics of fearing drawdowns, fearing risks, feeling greedy, fear of missing out, FOMO. So there's like a whole list of average human being reactions to events, purely psychological, which when you combine them together with 20 or more agents exhibiting those characteristics, you inevitably get fat tails. And I think there was a paper somewhere I read, and it was ages ago, and I probably can't find it in my files or anywhere. And if it's not, there should be a time now, given how advanced computers and AI have become. I would be really curious to do an updated study or a paper on this. Like, throw 20 or 30 or 100 agents, like half of them mean reverting, half of them trend following, half of them value and whatever, into a kind of synthetic market. Start with a little noise price series, and then send all these agents into this noisy sequence of events, and then from supply and demand and price movement of their price action, you will create an actual market. You will create a market, like when this guy's selling, when other guys are buying, and when everybody is acting within their rules. Let's see what kind of price series gets created, and I bet it's going to be a fat-tailed price series.
with no extra exogenous information, with nothing, no news, no nothing. Just let these guys slug it out between themselves, and you're going to produce fat tail. So I don't know
It's
where.
interesting,
Yeah, go
absolute,
on.
that,
Yeah.
yeah, look, um, when we're doing back tests and we're putting the results onto those, those landscape visuals where you're looking at the most stable parameters. What I'm worried about with continuous systems is that you're potentially not looking at the landscape of stability, and you find that with the continuous adjustments of your systems, you're actually sliding down to a minima as opposed to staying on the plateau. I'm not sure if that's totally relevant, but the way I get my ensembles together, so let's say I've got 10 trend following systems, what I'll do is I'll independently test those systems across 30 years of market history and then across my entire portfolio, so that I know that each of those systems has got a massive sample size accompaniment and they're very robust in nature. My concern with continuous adjustment models is that I don't know how we can robustly test all of the assumptions of that continuity in the variations of those models with those continuous adjustments. Do you have any thoughts on that?
Yes. Every continuous adjustment system is comprised of delta adjustment discrete subsystems. So including your ensemble, you may have 10, others may have more, but you can't have totally continuous. Everything has to be discrete at some point because you are making discrete adjustments. So you're basically quantizing the continuation of stuff. And I think every continuously adjusting systems is comprised of many individual non-continuous adjustment systems, just like you're doing with your ensemble, but it can be done in many different ways. So yes, the answer, and then each individual one has to have statistical significance on its own to be included into the ensemble.
Yeah,
So if
how do you do that?
Just like you do with the ensemble, but you can play with different things.
Okay.
Absolutely.
Okay.
When you look at the continuous system, do you calculate your statistics based on daily returns, or can you do you have some way to
Can you,
map trades?
Absolute, can you, or maybe Richard as well, in your view, can you define and really explain what a continuous system is? Like, what do you really mean by continuous system?
Well, yeah, as I said, Moritz, every system is discrete, right? Because we're making discrete adjustments once a day, or even if you're making it once an hour or whatever. So by continuous, I'm just making a distinguishing character separation. I'm distinguishing a system which after entry. So let's say a system has a zero position in crude oil, and now this system establishes a positive position, like, I don't know, 2 contracts and whatever. And then it goes to 4 contracts, then it goes to 7 contracts, then it goes to 5, then 9, 4, 3, 15,
So
16,
just position
2.
sizing we're talking about?
Well, we are adjusting position, but according to what? That's the Jerry says you should not adjust position according to volatility. So basically, that's an anathema. But you can adjust it for other things. So who's to say whether you can or cannot adjust a position on a certain change of events? Because with every new data, you have new information, new statistics about the market, about its volatility, about what it's doing, about its trend, and whatever. So according to that, you could be adjusting. And one of the way you adjust, Richard, you adjust size is through ensemble. One system gets you in, then another system gets you in, then the third system gets you in, and then the fourth system gets you out. So you constantly adjust. You have 2 contracts, 4, 6, 8, then 6 again, then 4, then 12, then 13. To an outside to an outside observer, your adjustment of position, if he doesn't know what you're doing, whether it's ensemble or whatever, it will be indistinguishable from me, who I'm also adjusting positions on daily, maybe weekly, or however the frequency is required. We are continuously adjusting a long position before we go back to zero, before we quote unquote exit. So Jerry,
I understand what you mean now. It's kind of like when you say, let's say we trade a 2-day breakout, 3-day breakout, 4-day breakout, all the way to an end day, 500-day breakout, right? You combine them all, you're very close to essentially creating a continuous curve. You can make this even more extreme and say you're trading minute bars, intraday systems, right? And the closer you chuck them together, the more you essentially...
Absolutely.
Right. So this... and at the end of the day, you're saying they're still discrete systems. They're just very, very close together.
Yes. Yeah. There's no black and white boundary between continuous and discrete, because even Jerry, who's trading binary systems, if his ensemble of 4 systems creates a continuous position adjustment.
Yeah. Well, maybe not necessarily. I mean, depending on how crude or how spaced these systems still are, it may still be the case, and there's a possibility that the position is zero and neutral, and all systems that you have combined give you no entry and no position, and then you're out of the
Absolutely.
market.
And I proposed this to Jerry. I don't know if it's been the spaces or in an email. One way to compare a binary system to a continuous system, because let's say even on a sample size let's even out the playing field in terms of sample size. Even continuous systems, theoretically continuous systems, can speak of a trade. Let's define a trade, any P&L between 0 position size. So any P&L. So let's say crude oil, you're 0. Then crude oil establishes a long position. So any P&L between now that you enter the long position to the next time you come to 0 or negative, you flip, you can consider that as a trade in your sample size. And you can have as many of those entries and exits. So 0 to 0 is an exit. So it could be a profitable exit or a loss exit when it zeroes itself out. And you can have a sample size of trades which are continuously adjusted. And you can compare that to a binary system.
Well, if you do this, you're now... I'm not saying it's right or wrong. I wouldn't do it that way, but I think what you're saying is you're bucketing all the trades together. So in your example, you establish a position, say a long position in crude oil, with an initial, 10 contracts, and then it becomes 12, and then it becomes 8, and then it becomes whatever. And at some point, you flip, or you go back to 0, or you go to negative. This is when your trade stops, and you would bucket all the sub trades that have changed your position size over time into the same bucket, and you would call this one trade.
Yes,
including the adjustment trades. That is not what I do. This
I don't do either. I don't do this either.
Okay.
But I would be curious to see whether even a continuous trader, a continuous system, what would be the statistics, average profit to average loss, and frequency of winning trades to losing trades,
but
just to compare apples to apples. That's what I mean.
Sure. If we don't bucket the trades, like in your example, but we keep them discrete and separate, then we have more sample size to analyze. And, I'd be interested in, or I am interested, I shouldn't say it in the conjunctive, I am interested in figuring out what exactly the P&L distribution and, the behavior of every single one of these trades is. I don't want to bucket them. I want to really spread them out and see them individually.
No, I agree, Moritz. By all means, you should do it. Yeah, I would do it the same if I was doing what you're doing. What I proposed is not as a matter of establishing sample size or quantifying robustness. I was merely curious as to whether the 2 main important numbers, so average win to average loss and the percentage of winning trades, would be improved on the continuous versus a non-continuous system. That's all I meant. So I didn't mean to.
Right.
And of course, you will have a smaller sample size. Yes, I agree. You will have.
Yes, got it. I see.
Absolutely. Can I ask you something? Wouldn't it be different to do an ensemble base, for example, in dates as opposed to in signals. For example, if you have like a simple moving average, right, and you have the choice of using it on each weekday, so for example, you have one system on Monday, Tuesday, another on Tuesday, etc. So you diversify the path dependency. That's one way. And the other way would be to use a 200-day moving average, a 100-day moving average, 150. Wouldn't those two diversification or ensembles produce very different results? Because on the one, when you're selecting the parameter of days, you could have the signal all at the same time, and that will reduce the ensemble to one signal taker. And the other, the date one, would be diversifying you always, no matter what happens on the market.
My gut feel is that when we're out in these chaotic regions of the tails, the assumption that we can apply these continuous methods, I appreciate where everyone's coming from, but I don't necessarily think it holds, because I think that the chaotic price activity in that region is something that defies our ability to manage the process, manage risk through our position sizing, all of these, manage volatility. I don't think we can do any of this management. I certainly do believe you can apply continuous models in more stable, predictable environments, but certainly in the tails, I've got real issues with that, and that's why I like to define all of my risk mitigation measures at the entry of a trade before potentially it gets into that chaotic region, and then when it does get into that chaotic region, the less I tamper, the less I adjust, the less I do, I don't try and adopt any information in that chaotic region, and I just let those models run to play out, giving them the loosest possible pants, the loosest possible trajectories. That's my only concern with the continuous models in our chaotic environments.
Yes, Richard. So I just wanted to answer Cordura's question. Cordura, can you remind me what the question was?
No, yeah, I was just asking if it's not different the way that you build the ensembles. For example, if you have ensembles that trade each day of the week, that will bring one kind of diversification on how you build your signals, and as opposed to, for example, ensembles that change the parameter of days of a moving average, right? Because on the second one, you could have the entry signals on every
okay,
parameter,
I got it.
every ensemble at the same time.
Yeah, I got it. Okay. So there are okay. So there's two main things why you want to diversify around the binary entry and exit systems. So for me, when I first started reading, that was 30 years ago, about trend followers and how they would all enter on the same day, and everybody knew that it's a new 20-day high or new 50-day high. So there was this other guys that were writing about turtle soup and how they're going to chop them up because they all knew they were going to get the signal today, and they're all going to jump in today to buy or tomorrow at the open. One reason to sprinkle your entries and exit is to camouflage your size and your intention to the market. That's one very important reason. Second one is diversification, statistical diversification, and third size is liquidity. Because I've traded pretty decent size when I was working at banks and hedge funds, and for some of the less liquid markets, I could not have traded these markets if I had a big binary and huge adjustments on one day or another day, or I have to distribute them over the whole week so that I don't become more than 10% of the volume in that market. But if I can sprinkle out my exits, basically by adding this chaos, by adding this little sprinkling this chaos around these digital binary points of importance, you're doing these three very important things. And they're all positive. None of them are negative. So this allows you to trade more markets with more size when you sprinkle it out, because otherwise you'll have to get out of orange juice or rice or whatever. There's like 20, 30 beautiful markets, and those those non-liquid markets, which a lot of the people who don't know how to do this or are too big, they're too big too soon. So somebody who's running 50 million or is going to give up on them. But if I can sprinkle around some chaos around them, I can run 500 million and still have them in my portfolio. So these are the things that help this so-called continuous development of systems and doing it. And also, as I said, if you do have an edge around your binary entry and exit, you will still have this edge even when you sprinkle some chaos around your binary exit and binary entries and binary exits and anything in between, depending on how many parameters you have. So to me, and also we've been talking about how it's, when something is hard, you should do it because not many people can do it. So on one hand, Jerry and on classical trend followers are saying, oh, it's hard to sit with the position and look at the drawdowns and whatever. I would suggest that it's even harder for you to be adjusting and going in and out and adjusting your position, let's say around eight or 10 contracts. So yeah, you go to 14 and you go to 6, then you go to 14, you go to 6. So you get whipsawed around 10. It's much harder to get whipsawed around all of these chaotic and sprinkling adjustments than to just sit on 10 and say, oh, now I'm losing, now I'm making money, now I'm losing, now I'm making money. So in terms of psychology, it's very hard. But if you let the computer do it, you don't even care. So, and this also, and it's another advantage, it's a fourth advantage of doing something like this, because you do trade more. And if you can control your transaction costs, if you track your slippage and whatever, it's harder. But it does offer many advantages.
But
Look,
isn't the
I really
one
want to
way of
get
West? Sorry, Richard.
no,
I
look, I
just
just wanted
wanted
to
to
get the Boney on because he's been patiently waiting for a long time, and I just want to say good day to him. He's active on Twitter Spaces, and go for it, Boney.
Good morning. Hey, Richard. Thanks for letting me come up and talk. I just had one quick question. Might be a dumb question, but I was just curious. Whenever you're diversifying, are you using a correlation matrix?
No, look, I don't. So what I do is correlation measures to me are sort of static representations at a point in time about how the different return streams relate to each other. What I tend to do is use, say I've got, 500 return streams represented by the X number of models across, say, 70 markets or whatever. What I do is I use all of the entire return stream over, say, a 30-year period for each of those models, and I iterate those return streams into clusters. So let's say that I'm looking for 70 return streams that I want the most uncorrelated relationship with over the entire 30-year period. What I'll do is I'll cluster them into groups of 70 by using iteration, which is a fairly heavy process using the computers, where it's putting bundles of 70 together in different sort of arrangements out of a total, say, 500 or so. It might have 500,000 different possible combinations of 70 groups in that 4,000, and this iteration process that I'll let my computer just chug away at ultimately comes to a situation where 70 return streams, uncorrelated return streams over 30 years, are selected. And I actually don't use asset class diversification, so I prefer to let my computer tell me what are the most uncorrelated return streams over a 30-year period, rather than make the assumption that I'm going to have X number of investments in commodities, X number of investments in fixed income, X number of investments in currencies. I let the computer do that. So I'm using the data of the 30-year return stream as a basis to put these collections together to get the best risk-adjusted returns. And that way, the computer's making my selection of my universe for me. I know that's different to what Jerry does, but that's how I do it.
Okay. Yeah, I've been doing some research and reading, and as you probably already know, correlations can be spurious. It's not like co-integration. And I was just wondering how you dealt with that, and I didn't know if you did use a correlation matrix, if there are any metrics that you use to kind of determine how spurious those correlations could be over time. Because then you could be making the bet that, those correlations were going to fall apart and hopefully fall apart in your favor to make money. But it sounds like you do something totally different. Sounds more high
Yeah,
level.
look, I do something different. So if you can imagine, let's look at the relationship between the S&P 500 and the SG Trend Index. You'll notice that if you take a snapshot in time, you'll see a very low correlation between SG Trend and the S&P 500, something like minus 0.01 or something like that. However, you'll notice over the 30, 40-year time frame, there are periods of time where it's very positively correlated, very negatively correlated, so in booms and busts, you get this flipping of the correlation. So there is no static correlation that you can use over the course of time. You've got to accept that correlations vary over the time dependent on the different regimes. So you need a method that doesn't make an assumption of a static correlation relationship. You recognize that markets are non-stationary. You need a process that can avoid making the assumption that markets are uncorrelated, because I inevitably find that doesn't persist over the long term. So that's why I use a process that tries to eliminate that problem we find with correlation measures.
Awesome. Thank you.
Cordura, you were about to say something before.
Yeah. No, I'm glad that Absolute spoke about the turtle soup, etc. Because I was thinking, what could I say that would upset Sherry a little, but he wouldn't remember next week. So
Oh, he'll
that
remember. He's now sitting at the beach. He's now yelling
yeah.
into his. Yep.
No, well, I hope not. But no, just kidding. But I understood what Absolute said. My concern was that sometimes I think that you can build a gradual entry, but in the end you will be exiting when something a huge tail happened, and everything will become binary again. If you know what I mean. I mean, in the end, you could be diversifying parameters, but then a huge event happened on against you, and you will be binary when you didn't want it, unless there is a huge volume and you can exit your systems without slippage in the middle of the day. That was one of my thoughts, because I think, if I understand what Absolute says, is either by design or not, you end up, when you see the buildup of the positions, you end up, when you add too many ensembles or systems or parameters, you end up being not binary. And I think that what you say is, well, I'm not by design. By design, I'm not doing an incremental position or volatility adjusting my trades. And I think what he says is, well, yeah, but when we see the positions, it's something similar, depending on how much you adjust and how frequently you adjust.
Yes, that's what I'm saying. It looks to somebody who doesn't know what each of us is doing, it looks like we're doing the same thing.
Yeah, that's what
Yeah.
I understood.
The from an outside observer, it's the same thing, and from an implementation point of view, you can also have similar implementations with a continuous or discrete system. So what I get from this is that ultimately this distinction is from an analysis point of view, isn't it?
So
And then I get back to Moritz's question first. Um, how do you measure the trades? Does it even make sense to say you're long and then you reduce your position because the signal is going against you, and then at some point you flip to short? Do you consider that a trade has ended and a new one has come out, or is it the same trade? How do you think about how do you think in those terms?
Well, I proposed. I've done this exercise a long time ago. Somebody asked me a question, so somebody above me asked this question. I did spend some time to analyze this. So one way to, this is just a one way, one very, how shall I say, a dumb way to put on even playing field a discrete trading system with a continuous trading system, where the continuous trading system continues a trade whatever is the PNL between a zero crossing. So you measure zero crossings. And even for this is even for investors. I did this for investors because they asked me, what's your average holding period? So for me to calculate average holding period, I have to calculate the average distance between zero crossings. So you have zero position, then you have some positive positions, sequence of positive positions, and then you come to the next zero, and that's a trade. Whether the size has been fixed between the zeros or dynamically changed, it's a trade, and you consider that as a trade. And the average holding period is the average distance between the zero crossings. That's what I meant.
Does anyone else want to come up and speak? I think I'm getting the hang of this.
Richard, sorry, just wanted to say that regarding Manesh's questions, that a lot of these things have to do to who is the final client, if is it yourself or another person. Because, speaking from some deep technical issues like what Absolute and you said, about there's no difference for the outside observer, or etc. Many of the things that ended up determining what you can or cannot do is who is the person who is listening to your explanations or listening to what you define. And if you are managing other people's money, I think a good compromise is to sell it to your clients as like they can use it as part of a portfolio, because it's very hard to sell it at 100% allocation. Although I think it's a very good way to manage money. But the second best would be, to say, okay, this is part of the portfolio, so it will complement what you already have. But at the end, even you don't know your clients, and even you don't know yourself as a client, because you have to suffer a lot to know who you really are or what you can stand. But just my 2 cents about that.
Yeah, so I've got issues with this in that um, I don't think investors have the understanding that we do in the way we live and breathe these strategies. So we recognise that you've got to be patient. It's incredibly volatile. It's counterintuitive in nature. All of these things that the investors we try to attract with AUM aren't aware of. And then, so really, they do need medicine, as Marty Luke was saying. They need this hard medicine. And do we avoid that hard medicine by giving them some paltry sort of, measure that makes things smooth for them, sort of makes them feel comfortable, when we know they need this hard medicine? Because what we're actually doing by giving them this smoothness, or by giving them what they want, is we're potentially compromising our approach with this warehouse risk that's going to bite us in the bum and going to have them in the long term coming back at us saying, you were supposedly professional investors managing our money. What the hell has happened here? And then we say, but we were offering you smooth returns over 10 years. Unfortunately, we didn't see this risk event because we compromised our models by responding to your needs, or by giving a small material allocation of trend into your traditional portfolio. That was a risk time bomb waiting to blow up. So I just feel that as a business structure, I think there is a responsibility to ensure that we act in the client's interests, and we understand what those interests are because we live and breathe these models. We know what's required to get the full benefit out of trend. By compromising that principle, I think we become guilty of basically creating a fragile system that's ultimately going to break over the course of time. And it's from our actions that we've taken, because we haven't been prepared to be solid in our stance, in our opinion and our philosophy. We've been weak, and we've compromised those to basically attract AUM. I think that's going to bite us in the arse over the long term.
No, I agree. That's why I think that second best compromise is to say, okay, use it as a part of your portfolio, but I wouldn't change the behavior or the construction. Just if you're not sure what it is, and the explanation is not as intuitive as something like buy and hold in the S&P. Well, put a little of it on your portfolio and use it as a winning strategy and also a diversifying one.
Anyone else want to say anything?
Yeah, I think this question about whether how a strategy should be designed for yourself or for clients I think I said this before. Right now the way I trade my strategy, I've designed it as I I only need to I don't need to add anything to the strategy, and basically I just need my strategy to. This is how I would manage the capital allocated to trading with my strategy. So uh, and but the question of whether it should be an addition to a portfolio, to a 60-40 or long bias stocks and bonds and whatever. These are much, much deeper and more philosophical questions that actually should address your views as to your view on money, where money comes from, how the fiat systems is built, and how what the central banking is doing, what is the longer uptrend on prices, whether it's going to be there permanent inflation or not, whether assets are meant to just go up in price or not, and whether that's just a God-given thing or is it just something that's happened over the last 50 years after the dollar finally got disconnected from gold and the whole planet got disconnected from sound money. So these are deeper and deeper philosophical questions that you can discuss with an investor or with yourself, and to decide under what circumstances you do need to have some exposure to stocks and bonds with some long bias, and under what circumstances that bias should be unplugged and completely destroyed because the premise for which you have it is not there anymore. And that's dependent on different outcomes of where the world is going, where markets are going, where central banking is going, where the systems are going. And this is, and this I think has to be then connected with your assumptions and your premises that you have in your system, and what to propose, whether you should trade your trend following system together with a long only portfolio with a 60-40, or to maybe have a bigger allocation to stock indices or bonds, but with a trend following overlay, so that when the system changes finally after the 50 years, you're still protected, you're going to be stopped out, you're not going to be buy and hold all the way to zero on them as a protection. And this is a once in every 50 or 100-year event from which you may or may not have protection. So if you have somebody who has explained this to an investor, listen, this is not backtestable. Yes, I know buy and hold has worked well, 60-40 has worked well over the last 100 years. I can see the equity curve and whatever. But the world is never the same. The next 100 years or 50 years are not going to be the same in the last 50 years. That's for sure. And there's possible events that could happen that can make buy and hold a complete disaster, which can make 60-40, the 60-40 50-year backtest or 100-year backtest look like long-term capital management. And in that event, it may pay to have somebody like a trend follower to say, listen, we will be long and we will be long enough, these things that everybody is long, but we will have something to protect us if this happens. It's going to cost us a little bit of trading, a little bit of whipsaw, a little bit of drawdown. We may get down out at the bottom where everybody is going to be adding to a drawdown and everybody's going to look smarter than us because we got out. But then we're going to go back in. We're going to miss some of the upside, but we're going to be protected. This is all because we bought ourselves some insurance for an event that happens very rarely, but is disastrous to most. So these are questions when you sit down with an investor, that it's not just, oh, let's combine this backtest with bonds and stocks and see which portfolio is the most optimal and better sharp, best and sharp and whatever. I think these discussions should go much, much deeper than that.
No, I agree. And I think that one of the main issues with trend following, it's something that I think it shares with, for example, Charlie Munger's philosophy of investing. when he said, it's amazing how far we went just by trying not to do stupid things. And I think that the trend following shares that with Manger's philosophy, meaning that you are breaking your risk packages in small chunks, so you don't get, you don't get hammered by one event or two events, etc. I think that's deep. It's also simple, and I think that's what's underneath the design of everything that one does as a trend follower. And also, I agree with you. In that interview of the Renaissance CEO, he says that Jim Simons told him, "Would you invest all your money in the S&P?" And P? And he said, "No, because it's a lousy risk return proposition." So, and then he said, "Well, so go and build something better so we can sell it to institutions." Now you can say that they did it for the fees, etc., or to dump their own positions. But you know, I agree with you that buy and holding is something that you at least should consider in terms of how much can you handle of that big drawdown.
Oh no, go ahead, Demona.
I was just gonna say, I recently read a book about Renaissance, and they got several different funds, and I think the equity fund really, I don't think it's had that much of a outstanding performance, if I understand correctly. I think it's just
No, it's lousy. It's lousy, and I think that many people suspect that they are using it to dump their positions on the main fund, or they're just trying to build assets to
yeah.
to get
So
the
so
fees,
the
etc.
medallion fund that people that work there have access to. That's the one that has the high returns. That fund started out, they were primarily focused on futures trading, and it actually started out. It was medium to long term, and they were using trend following, and then it gradually moved to more short term. And then I think they started adding some statistical arbitrage. So some of it was futures trading, and some of the returns were from equities, statistical arbitrage in equities. But yeah, I just was going to say that I think that their pure equity fund is not really, and I think a lot of investors over time ended up being disappointed by the returns on the pure equity fund.
Yeah, look, when I look at Renaissance performance, it's pretty not that wonderful at all. But Medallion, of course, is, and it's interesting. Jacob Schott, who's he mentioned just in a funny way, he said perhaps Medallion is using Renaissance for its spectacular returns. But I mean, I just can't. Until we understand what's under the hood of Medallion, I tend to sort of shy away from comparing ourselves to them because you just never know what they're doing. And I much prefer these transparent funds like Trend Following, etc., which have had these fantastic returns. Yes, maybe not as good as Jim Simons, but I'm prepared to say, well, at least I understand these trend following funds and their performance is incredibly good. Until I know what Medallion's doing, I don't really care what reported returns supposedly Zuckerberg says that they give. I just don't know. We don't know what's going on underneath the hood.
Hey, Cordura, which interview was this? Who interviewed whom?
I'm gonna post it. It's some guy from Goldman Sachs who interviewed the Renaissance CEO, the current
Who?
CEO,
The
Brown,
not
the
Jim
guy from
Simons, right?
no, no, one of the two guys from IBM,
Okay, okay.
who is the
And I
current
want,
Okay, yeah,
CEO.
post it, please. And where
Yes,
was the podcast? Was like on some Goldman Sachs website, or is it what?
yeah, it's in Goldman Sachs website. I'll put the link there.
Okay, perfect. Thank you.
Devoni, you've got your hand raised. Do you want to say something
Yeah,
else?
so I was Top Traders Unplugged. They recently did an interview with Katie Kaminsky, and I was listening to that a couple days ago, and she was talking about trend following and using some of the trend following methods, but also combining those methods with like some machine learning elements that I guess analyze price data. I think she was saying that they use some of that to kind of confirm their entries. I don't think that they hang their hat on that, but it's just another tool to kind of, I guess, reinforce their bias. It might be like what an equity trader would do when they turn to like a technical analyst to like look at price chart, trends and chart patterns and so on. I was just wondering what you thought about that in terms of just kind of reinforcing it, or if you use machine learning to kind of as a reference to reinforce what your trend methods are telling you.
Look, I don't use machine learning simply because, I believe we've got this little competitive advantage out there in the chaotic region of the tails, where artificial intelligence, machine learning, these things don't work out in those chaotic regions. And so I tend to think that 90% of the participants are focused on the predictable qualities of the market. 10% are prepared to invest in those tail regions. So 90% I view as predictive modelers and 10% I view as non-predictive price followers. And there's a few strategies like ours, tail protection strategies, what we're doing, price following with our trend. There's a couple of sort of divergent strategies that represent that 10%, but 90%
Well,
of these
let me ask you
predictive
this: you were
types.
talking about market regimes, and you're saying you don't use correlation matrices, but you divide up, say for 70 assets for 30 years, you divide up the returns for each year, and you're kind of using that data. That kind of sounds like a hidden Markov process because you said you were looking for regimes, and you were using the regimes to kind of lay out your bet.
Yeah, so I don't use any form of Bayesian reasoning. The reason is that in these chaotic regions, with more information, well, there's very little information you can extract from them. So Bayesian reasoning, Markov processes are very, very efficient techniques in predictable regimes because you're continually updating your predictive function as you're getting more and more information in, and they're very accurate. It allows you to become very precise over the course of time in very stable, predictable markets. However, those processes, I think, tend to break down in those chaotic regimes where you've got to go the total reverse to predictive methods, where you become, loose pants. You avoid precise expected trajectories. You're doing everything to give maximum freedom for price to move within risk constraints. So really, we're applying a risk management model, a simple risk management model in a chaotic regime, as opposed to a predictive approach, which is applying a technique to target precisely a future desired target. It might be fundamental value investors who they've done their analysis, they've worked out what intrinsic price should be in the future, and they're looking at where current price is, whether it's overvalued or undervalued in relation to that intrinsic price in the future, with the assumption that price will converge or predictively converge to that intrinsic state. That's the value pattern recognition, exactly the same process. The past patterns identified through the back test, the assumption is that once you see those patterns in the future, there will be some predictable price move associated with the fact that we've seen it in the past. Pattern recognition, AI, all of these things, a lot of technical analysis, all of these things are based on the premise that the past holds a secret to the future. However, with our price following models, we're going on the other side of the spectrum, saying that there is no thing we can hold on to with the past with reliability because the future is uncertain. Therefore, we've got to put a risk framework into that uncertainty, a simple risk framework that basically cuts losses short. It prevents us from getting left tail events with our strategy, but gives maximum degree for right tail events, profit running, etc., in these leptokurtic tails.
Well, let me ask you this,
And
because
I
this
was
kind of seems a little bit tangential, but I'm going to tie it in or try to tie it in. So, like what we've seen in OJ and the Mexican peso, like what percentage of that move do you think is actually speculators like yourself versus uh, commercial hedgers? Who do you think predominantly moves the mark more in markets, or is it different for each asset? Well, let's just say for OJ, do you think speculators are moving the mark on OJ on a day-to-day basis more than commercial hedgers?
To be honest, I've got no idea, but I don't worry about that. All I'm worried about is that there is this trend in place. I've got my models that have waited for the material price excursion and jumped on board that trend with the hope that it turns into an outlier. I've got no idea
Well, what
what
I
is actually
I think
driving that.
what I'm getting at is if the speculator had more governance over the price day to day, and everybody has the same incentives, and you subscribe to this chaos theory and positive feedback loops, if you see something that's in an uptrend, there's probably 1,000 other guys running money that are wanting that to be an outlier for the year. And so it kind of
Yeah, but a
becomes
lot of those.
self-fulfilling.
So when those trends get extreme, you know how I was saying 90% are predictive, 10% are price following. There'll be the 10% price following riding the OJ trend in the direction of that trend. But what happens, the 90% predictive mob will be saying, God, that trend's gone too far. It's going to mean revert. Now, they've got predictive models in that, which are counterposition to our price following models. But when they either exit their position or they average down into their position and leverage up and then ultimately exit the position because they get squeezed, that trade behavior of them exiting in panic, that actually accentuates our trend. So what we find is that when these trends evolve, initially there might be 10% participants riding that trend, 90% are sort of trying to sort of counter trend it, assuming it's going to mean revert. And then over the course of time, 20%, 30%, 40%, 50%, there's a mass migration of behavioural impacts, which is amplifying the trend further as people are getting squeezed. And then when you get that tipping point, 50, 60%, 70%, the trend ends. And that's how I see this sort of positive feedback loop during these massive trends. I see this positive feedback loop. We see it in 2008 with what we call the capitulation tails. You'll notice that as the market's declining, the price moves are getting actually more and more accentuated. There's this positive feedback driving that momentum down. And that's the impact of the 90% predictive getting squeezed to death, having to sort of exit their positions, which is accentuating that trend until we get the trend ending and a new regime sort of evolving from that point in time. That's how I'm interpreting it all occurring.
Okay, I got you. I did read somewhere that those machine learning, they studied these systems for the longest time, and ultimately they concluded that the machine learning systems were just that more so mean reverting in nature. So I guess I see what you're saying.
Yeah, I agree with that. I think that's right. I think they're very effective for predictive regimes, but no good in our chaotic tail regions. But look, everyone, I think we've had 2 hours here. I think it's been a great session. I hope I've done Jerry justice. I hope he's not fuming at the mouth on the beach somewhere with his wife, but he'll certainly get back next week and have a crack at us if we've said any wrong things. And it's been great, everyone, and take care.